Are you looking to apply for a new credit card or a personal loan? Then you must know what are the changes that the RBI has made that can impact your borrowing costs when you go and apply for a personal loan or a new credit card. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and on this video, I'm going to help you really understand what has the RBI done, why has the RBI done this, and what could be the impact on banks as well as consumers or borrowers at large when the RBI recently made the move of introducing higher risk weightage for unsecured loans. Remember, the RBI has now stepped in to curb the relentless rise in consumer loans. In the last 2 years alone, what we have seen is that the unsecured retail credit has spiked 23% as against the overall credit growth of about 12 to 14% in the entire system. In fact, the credit card outstanding loans have also seen an increase to 30% on a year-on-year basis by September of 2023. The other personal loans have seen an increase of 25%. Consumer durable loans, all your white good loans, like, when you go ahead and buy television sets, your refrigerators or your ACs, these loans have also recorded an increase of 11% as per the recent RBI data. During the same period, the overall bank credit has only increased 20%. Now, the data from Credit Bureau TransUnion CIBIL has also showed the delinquencies defined as loans overdue by more than 90 days. These were at 0.84% for entire basket of personal loans, but for loans below 50,000 rupees, they were as high as 5.4%. Now, the RBI had constantly been warning banks as well as NBFCs on the risks of the uncontrolled rise in consumer loans and in personal loans of late. And when the banks and the NBFCs were not really listening, the RBI decided to take the things in their own hands. And then the RBI has now increased the risk weight against consumer loans, including both personal loans and the credit card loans. The risk weight has now gone up by 25%. The risk weight has been increased from 100% earlier to 125% in the case of these unsecured loans. But remember, before pre-COVID levels as well, we had seen that the risk weight was as high as 125%. It was only during the COVID period that this was brought down to 100%. So now they are back to the pre-COVID levels. At the same time, the increase in weight will now ensure that the system stays insulated from any kind of potential risks arising from the rise in unsecured loans in the system. This means that the banks and the NBFCs will now have to make higher provisions against all of these loans. The loans they extend on personal account, the loans they extend on consumer durables, the loans they extend via credit cards. Higher provisions are needed to cover the risk of a default from borrowers as these loans are completely unsecured loans, which means they are not backed by any sort of collateral which can be used to repay in case a person or a borrower is not able to repay the loans raised from these particular accounts. These measures will make it difficult to lend more by the banks and NBFCs to consumers. At the same time, they will increase the risk cover for these existing loans as well. So what will this action do to the banks? Let me explain that to you first. For banks, this will force them to allocate more capital to risky loans, thereby increasing the minimum capital ratios based on asset classification. In simple words, for consumer loans, banks will have to now set aside higher amount of capital, provide for them that, in case this loan goes bad, I have a provision. I have a higher capital back in with me to provide for any kind of risk arising from a default in case this borrower does not pay me back the loan that they have raised. Now, the RBI's move also sent stocks of banking names of NBFCs, all of these down in trade on November 17th as well. We did see as a knee-jerk reaction because the cost of lending will become more for all of these banks and NBFCs. These stocks started to fall. It was a Freaky Friday in the early trade for some of these banks like RBL Bank, Satin Credit Care, Aditya Birla Capital. All of these were major losers in the initial part of the trading session. They plunged anywhere between 5 to 7% odd as well. In fact, we also saw the stock of Bajaj Finance, for example, that actually on an intraday level had declined about 2% in trade, but then recovered later on. So IDFC Bank, SBI, Axis Bank, you did see a slew of banking stocks really decline in trade as well. Among the fintech giants, we did see SBI cards as well seeing a decline of over 5%. Paytm also slipping about 2% in trade as well. You can see a slew of these stocks which we are showing to you as of the data of on November 17 to really get a sense of how red the screen was when it came to the banking stocks, the financial services stocks as well, that all were coming under pressure because of this news flow. But how will this news now impact borrowers like you and me? That is something that you need to understand. Now, for consumers, definitely this is not very good news, because when banks are forced to set aside more capital on certain loans like personal loans, consumer durable loans, and credit cards, they tend to increase the rate of interest charged to the borrowers for such loans to make up for the potential loss that they have, because they are putting aside extra capital which is not available with them at disposal or some at disposal or something. Secondly, these banks and non-banks will also now be more careful while issuing such notes. So naturally, all the lenders will put a brake on the pace of issuance. Say if they were giving out personal loans 100 in a day, now that could actually come down as well, which means it will now get more difficult for you to apply and get for a personal loan. Now, there are several categories under which personal loans, credit cards, consumer loans are extended. The banks have some check balances to make, or some points to check, and then they give it out to some people. Those norms perhaps will get it stricter to now sieve through the number of loans that will go out on an everyday basis as well. Now, if the banks also put down more capital to lend to NBFCs, again, they will charge higher interest or not lend at all. So the banks, NBFCs also, it will be difficult for them to get raise loans from banks. So for NBFCs to give out loans, again, it is going to be a challenge. Ultimately, the consumers of personal loans, credit card loans, consumer durables will have to be very careful and think through, and perhaps also face delays and higher interest rates when you now apply for a fresh set of a loan or not. And that is what the RBI really wants also. The message to the banks and NBFCs from RBI is pretty clear. You go slow, be careful on risky loans. That's what the message is from the Reserve Bank of India to banks and NBFCs, so that the banks don't end up in another round of a bad loan crisis, sooner or later. Remember, the Indian banking system has really come out of a bad phase when there was a rising bad assets problem, NPA problem, capital adequacy issues as well. They did not have, and higher provisions. All of these were really impacting the banking, the balance sheets of these banks and NBFCs. Finally, after long, they are now adequately, they have adequate capital with them on their books as well. The bad loans are not as high, but to prevent a similar crisis is what the RBI has taken this measure because of right now. Now, clearly, the regulator has learned hard lessons from the past cycles. When the economic recovery gets delayed, it is the unsecured loans that go bust first, and which is what the RBI clearly wants to avoid at this point in time. However, there is some breather as well, especially for consumers or for borrowers who want to apply for loans such as home loan, for example, auto loans or vehicle loans, for example, or maybe a gold loan as well, because the RBI circular does affect consumer loans in general, but excludes housing loans, education loans, vehicle loans, and loans secured by gold and gold jewelry as well, gold bonds and gold jewelry. So these loans are exempted from the new RBI rules that have come in. Now, in the earlier bad loan cycle, Indian banks had seen a sharp rise in unsecured loans during the economic downturns when we did see job losses, income losses hit borrowers as well, and therefore the repayment became very, very difficult too. That is what the RBI does not want to repeat. In the financial stability report released on June 28th, the RBI had clearly said that the share of large borrowers in the gross advances of banks had declined over the last 3 years, but retail loans grew faster than the borrowings by corporates. And this was a sign that the RBI was clearly watching with a clear lens. Now, the share of big borrowers declining from 51% in March 2020 to about 46% in March of 2023 was something that the RBI was watching, but at the same time, the retail borrowings were rising, like I initially pointed out to you. And this is the reason why the RBI governor has warned about such loans during the October monetary policy presser as well. So the RBI's move on risk weights was actually not a very big surprise. The writing was already on the wall because the RBI was constantly issuing such warnings before banks and NBFCs. Now, what you need to do is stay tuned onto Business Today Television to really find out how much more your personal loans could cost you now with the new RBI norms in place. And we will help you with all of that in the upcoming videos. Many thanks for tuning in onto this one.